What are candlesticks? How do I read candlesticks and candlestick patterns? When and how should I trade the candlestick patterns like the engulfing candle, the harami, the tweezer top, and bottom? In this video, I'm going to teach you all you need to know about candlesticks. Let's start from the basics. Candlesticks consist of bodies and shadows, usually termed as wicks. They are formed using open, high, low, and close of the chosen time frame. If the close is above the open, the candlestick is bullish. If the close is below the open, the candlestick is bearish. Let's use a scenario for better comprehension. Assuming the market opened at this price and moved downward, creating our low at that given time, but the candle moved above the price it opened at, creating our high, and pushed back down, yet it closed above the price it opened at, then that's a bullish candle. So we have a high, low, open, and close, as indicated. If the market opened at the same price but moved upward, creating our high at that given time, yet the candle moved below the price it opened at, creating our low, and pushed back up, but it closed below the price it opened at, then that's a bearish candle. So we have a high, low, open, and close, as indicated. Most trading platforms use red color to refer to bearish candlesticks and green to refer to bullish candlesticks. But the color doesn't matter. You can use whatever color you want. Long bodies refer to strong buying or selling pressure, and short bodies indicate a little buying or selling activity. These are what we term as shadows or tails. A candlestick consists of an upper shadow and a lower shadow. In rare cases, a candlestick may contain only one shadow or none at all. The shadows of the candlesticks give meaning to what happened at a given time. A candlestick with short shadows indicate that most part of the trading action was confined near the open and close. If a candlestick has a long upper shadow and a short lower shadow, it means buyers flexed their muscles and bid price higher, but for one reason or another sellers came in and drove price back down. If a candlestick has a long lower shadow and a short upper shadow, this means that sellers flexed their muscles, but for one reason or another, buyers came in, drove price back up. If a candlestick has similar long shadows or similar short shadows with a short body, this means there's an indecision. However, if a candlestick has similar long shadows or short shadows with a long body, it means that buyers, if price closed above, and sellers, if price closed below, are in power. Engulfing bar candlestick pattern. The engulfing bar candlestick, as stated in its title, is formed when a candle fully engulfs its previous opposite candle. We have the bearish engulfing bar and the bullish engulfing bar. The engulfing bar consists of two bodies. The first body is smaller than the second one. In other words, the second body engulfs the previous one. This candlestick pattern gives us valuable information about bulls and bears in the market. A bearish engulfing bar tells us the sellers are in control of the market, and a bullish engulfing candle indicates that buyers are in control. What to note about engulfing bar? It is the highest probability candlestick pattern ever. However, engulfing bar candlestick pattern cannot be traded anywhere it occurs. It must be backed by additional technical analyses by using market structure or indicators. This goes for all other candlestick patterns. Here are real chart scenarios for the engulfing candle. I'll identify the engulfing bars in the first chart, and you will do the next chart. From this chart, these are the engulfing bar candlestick patterns identified. Can you identify the engulfing candlestick patterns in this chart? Here are the engulfing bar candlestick patterns in this chart. How to trade the engulfing bar candlestick. The engulfing bar candlestick is best traded when it is in line with the trend and it forms in an order block. For example, after we had a high and low, the market broke the structure to let us know it is in an uptrend. We then place our break of structure line, change of character line, and order block. Market gets to our order block and presents us with an engulfing candle. We then enter the market and set our target profit and stop loss. In a downtrend scenario, a bearish engulfing bar candlestick was confirmed in the order block after price retraces. Therefore, we enter and set our target profit and stop loss. If you're a bit confused here, you can watch my previous video on market structure to have a fair idea. Another strong zone for the engulfing bar candlestick patterns is the use of support and resistance lines. As you can see in this example, the engulfing candlestick pattern bounced of the resistance line. We then enter the market and set our target profit and stop loss. And in here, the engulfing candlestick pattern was formed on our support line, so we enter the trade and set our target profit and stop loss. There are other times that the engulfing bar candlestick pattern becomes useful. Examples are double top or double bottom scenarios, chart patterns, pairing it with an indicator like the RSI and counter trending. Just make sure that whatever strategy you're using, the engulfing candlestick pattern is traded in conjunction with a confirmation from your strategy. Now let's move to our next candlestick pattern, the doji candlestick pattern. A doji is formed when the market opens and closes at the same price. It tells us that there is equality and indecision between buyers and sellers. When this pattern occurs at the top of an uptrend or at the bottom of a downtrend, it usually indicates that market is likely to reverse. Apart from the main doji, there are two types of doji candlestick patterns. The dragonfly doji, which indicates buying power and control, and the gravestone doji candlestick pattern, which indicates sellers in control. What to note about doji? The doji usually indicates an exhaustion of power when it forms at the peak of an uptrend or a downtrend. Trading doji at any point in the market is a bad idea. Here are real chart scenarios for the doji candle. From this chart, these are the doji candlestick patterns identified. Can you identify the doji candlestick patterns in this chart? How to trade the doji candlestick pattern. To trade the doji candle, you first have to spot the trend of the market. After identifying the trend of market, trade a doji candlestick pattern if it forms after a long bullish run in an uptrend or a long bearish run in a downtrend. The doji candlestick should be valid only after a break of structure. If you tend to trade the doji candlestick pattern, remember to have your risk management intact. The doji candlestick pattern can be used as an indication of a trend losing its strength. So if you're already riding that trend, it might be time to take profits. If you've made it this far, kindly like this video and subscribe to my channel and hit the notification bell to be updated on more clear teachings of the market. Morning Star. The morning star is a bullish reversal pattern. However, it can be used to continue a trend. It consists of 3 candlesticks. The first candlestick is a bearish candle. The second candle is a small bearish or bullish candle, usually very close to the open of the candlestick, or sometimes an indecision candle. And the third candle is a bullish candle that gapped up on the open and closed above the midpoint of the body. Here are real chart scenarios for the morning star candlestick. From this chart, these are the morning star candlestick patterns identified. Can you identify the morning star candlestick patterns in this chart? How to trade the morning star candlestick pattern. In the case of a downtrend, the morning star can be used as a reversal when it forms outside the discount zone and at a support area. In the case of an uptrend, the morning star candlestick can be used as confirmation to continue an uptrend with our break of structure line, change of character line, order block, entry, stop loss, and target profit. Evening Star. The evening star is a bearish reversal pattern. However, it can also be used to continue a trend. It consists of 3 candlesticks. The first candlestick is a bullish candle. The second candle is a small bearish or bullish candle, and the third candle is a bearish candle that gapped up on the open and closed above the midpoint of the body. Here are real chart scenarios for the evening star candlesticks. From this chart, these are the evening star candlestick patterns identified. Can you identify the evening star candlestick patterns in this chart? How to trade the evening star candlestick pattern. In the case of an uptrend, the evening star can be used as a reversal when it forms outside the discount zone and at a resistance area. In the case of a downtrend, the evening star candlestick can be used as confirmation to continue a downtrend with our break of structure line, change of character line, order block, entry, stop loss, and target profit. The hammer. The hammer candlestick, also known as pin bar, is created when the open high and close are roughly the same. It is characterized by a long lower shadow that indicates a bullish rejection from buyers and their intention to push the market higher. Here are real chart scenarios for the hammer candlestick. From this chart, these are the hammer candlestick patterns identified. Can you identify the hammer candlestick patterns in this chart? How to trade the hammer candlestick pattern. It is mostly effective when it forms at the bottom of a downtrend near a support level. The shooting star. The shooting star, also known as the bearish pin bar, is the opposite of the hammer candlestick. It is formed when the open low and close are roughly the same price. It is characterized by a long upper shadow. Here are real chart scenarios for the shooting star candlestick. From this chart, these are the shooting star candlestick patterns identified. Can you identify the shooting star candlestick patterns in this chart? How to trade the shooting star candlestick pattern. It is mostly effective when it forms at the top of an uptrend near a resistance level. The harami pattern, inside bar. The harami pattern, which means pregnant in Japanese, is also termed as the inside bar. It is considered as a reversal pattern. There are two harami patterns, the bullish harami and the bearish harami. The bullish harami consists of two candlesticks. The first is the large bearish candle, which is the mother, followed by a small bullish candle, which is called the baby. The bearish harami also consists of two candlesticks. The first is the large bullish candle followed by a small bearish candle. How to trade the harami candlestick pattern. In a downtrend, the bullish harami can be used as a reversal signal to push the market up as shown in this chart. Now with bearish harami, when the market is an uptrend, it can be used as a reversal signal to push the market down as shown in this chart. The tweezer tops and bottoms. The tweezer top is considered as a bearish reversal pattern seen at the top of an uptrend, and the tweezer bottom is considered as a bullish reversal pattern seen at the bottom of a downtrend. The tweezer top consists of two candlesticks. The first one is bullish followed by a bearish candlestick. It indicates that buyers pushed the price higher, but sellers surprised buyers by pushing the market lower and closed down the open of the bullish candle. The tweezer bottom consists of two candlesticks. The first one is bearish followed by a bullish candlestick. It indicates that sellers pushed the price higher, but buyers surprised sellers by pushing the market lower and closed down the open of the bullish candle. How to trade the tweezer tops and bottoms. For the tweezer top, if it happens near a resistance level in an uptrend, the market is likely to reverse, so we enter the market and place our target profit and stop loss. For the tweezer bottom, if it happens near a support level in a downtrend, the market is likely to reverse, so we enter the market and place our target profit and stop loss. So now you know how to identify and trade the engulfing bar candlestick pattern, the doji or indecision candlestick pattern, the morning and evening star candlestick pattern, the hammer and bearish pin bar candlestick pattern, the bullish and bearish harami candlestick pattern, and the tweezer top and bottom candlestick pattern. However, my best picks that should really have your attention are the engulfing bar candlestick, the morning and evening star candlestick pattern, the harami candlestick, and the tweezer top and bottom respectively. I recommend you visit this video from time to time because trading takes time and you're likely to understand the concept the more you go over it. If you want more clear teachings in trading, kindly like this video and subscribe to my channel. Have a great trading week.